So we've talked about the four parts, the four pieces of information we need to set price. Let's talk a little bit about pricing methods. First, when we get ready to select the final price, we have to develop an overall promotional pricing policy. Are we going to focus on sort of having everyday low prices? That is, are we going to focus on prices that don't change from day to day? McDonald's is a good example of this. Their prices, they very seldom put anything on sale. Almost always McDonald's will add new products as a promotional item, but they don't tend to lower their prices. Another approach is to have my prices set and then have promotional sales. Grocery stores do this, right? They have regular prices, and every week they send out ads to people with lots and lots of products that are actually promotionally priced to try to increase traffic to the store for that week. In terms of things like fast food restaurants, Arby's typically has a number of their products on sale, as does Jack in the Box. Okay, so one approach would be to have a price and maintain that price. Another approach would be to have a price but then discount that price and have promotional sales to try to increase traffic. The third promotional pricing policy is a negotiated price strategy, and this is typically for higher priced goods, whether it's an appliance or an automobile or for many businesses it might be some sort of business purchase. This is the idea that I have a list price, but I am willing to negotiate a price that is different than the list price. Automobiles are a really good example. Almost no one actually pays the list price for an automobile. A friend of mine in the accounting department recently bought a Corvette, a brand new Corvette convertible, and he actually got that price negotiated down to about $7,000 or $8,000 off of the list price. Now, one of the things you have to do when you're looking at these promotional pricing policies is understand its impact on customers, competitors, and your sales force. If you use a lot of promotional pricing, your customers then become a lot more price sensitive, and your competitors perhaps become more aggressive trying to match your prices, and your sales force then has to try to figure out how to sell the products that have the higher margin. So when you come up with selecting a pricing policy, understand that it impacts your customers, it impacts your competitors, and it impacts your sales force. Then we need to select a pricing method. Your book talks about 4 different pricing methods. We typically talk about 3 pricing methods. That is demand-oriented pricing. That is methods that are designed to maximize profit or revenue. Cost-oriented pricing that are basically pricing methods that the price is determined based on the cost of goods sold. And then competitive pricing strategies where we use the competitors' prices as a point on which to base our prices. Now, your book actually uses 4 versions of this, and this is a chart from your book where they talk about demand-oriented approaches to pricing, and they talk then about skimming pricing, penetration pricing, prestige pricing, price lining, odd-even pricing, target pricing, bundling pricing, and yield management pricing. Let me just spend a minute or two talking about these. The book does a nice job of explaining these, and you need to be familiar with them. A skimming strategy is when I have a brand new product and I charge more for that brand new product in an attempt to recoup my research and development costs and to get as much profit as I can before new competition enters into that business. And so if I generate a brand new product, one of my strategies might be to use a skimming strategy. A penetration strategy is just the opposite, where I go in and I try to set my price at a place where I get the most units sold, with the idea of grabbing as much market share as I can, and then later on figuring out how to turn that market share into more profits. There's a demand-oriented pricing where I have prestige pricing. An example of this would be a store like Hermes. You go into Hermes, and I was in Hermes the other day. The belts that they sell in Hermes start at $200 a piece. That's all about prestige pricing. Belts are just belts. And then there's this issue of demand-oriented pricing with price lining. That is, I have a line of goods and I set the price in such a way that I try to steer people to upsell themselves to the most expensive product in the line. Odd even pricing is this notion of charging $1.95 rather than $2 for a product. And while we all say, well, that doesn't really work, research over and over again shows that people think that something that costs $1.95 is dramatically less expensive than something that costs $2.05. We can do target pricing where we are aimed at a particular price point, and that's our focus. Remember, we talked about the Honda example about that earlier on. We can do some sort of demand-oriented approach to pricing where we bundle things together. Things like value meals at McDonald's, where we bundle something that's a low margin item, a quarter-pound cheeseburger, with something that's a high margin item, French fries and a soda. And then finally, there's this notion of yield management pricing. Yield management, the best example of yield management pricing is when you go online and look for airline tickets. You know that airline ticket prices change almost daily. And the idea behind that is to sell as many tickets as I can at the price at a higher price, and then continue to lower price until I have sold every seat available on that airline. Yield management pricing seems like a really good idea, but it has a number of negative drawbacks, including making customers more price sensitive. The two areas where you tend to see this the most is in the airline business and the hotel business. And it might be because those people don't know very much about pricing, but it also understand that, think about two areas where, when you look for an airline ticket, what's the first thing you look for? I know you're going to say lower price. It turns out it's destination. But the fact is that you become very price sensitive for traveling on airlines because they keep changing prices. And think about it for hotels. You do the same thing for hotels. When you shop for hotels on Travelocity or Trivago or anything else, what you do is you look for the lowest price hotel rooms. And that's the big drawback, of course, with yield management pricing. Cost-oriented approaches, a standard markup. For instance, in the clothing business and most retailers, the standard markup is called a keystone, or simply taking the cost of goods sold and doubling it. So when you go to the store and you look at the list price for a good at a clothing store, it typically is 100% markup on, or doubling the cost of the goods sold. There can be a cost plus, where I simply take the cost and then I add a particular number to it. It could be a percentage number, or it could be an absolute number. And then there's this cost-oriented approach where we talk about experience curve pricing, where the goal is to move down the experience curve where my costs go down the more units I produce. Also, an economy of scale-oriented cost pricing approach is another one that comes under the cost-oriented approach. Profit-oriented approaches, including a target profit approach, where I have a particular amount of profit in mind and I try to set my prices to reach a particular target, or a particular target return on each sale, or a target return on investment. And then finally, we have competitive approaches to pricing, and this is sort of the customary price, or at or above or below. Remember, we talked a little bit about that. Or in fact, some competition-oriented pricing is things like loss leader pricing, which we talked about earlier on. The idea of using some goods as very low priced items to build traffic to your particular store or website. So, selecting a final price, a couple of things to remember. One is armchair quarterbacks and second guessing goes on all the time. Every time a company sets price, there are a number of people who think that the price should be something different. But there is great value in consistency. That is, once you come up with a pricing policy and a pricing method, it's important to remain consistent in terms of how you do that pricing. And then, of course, my last word on selecting a final price, use some common sense. Once again, in summary, the four basic rules in all pricing: know your costs, know your demand, know your competition in your market, and know your pricing objectives. Those are all important things to know before you set price.